It's time now for the big picture. So let's welcome in Nate Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research. So what do you make of sort of the price action we're seeing today, Nathan, off the back of what has been, still continued fairly good earnings? I mean, we've got a beat rate of over 80% so far. Is this a sort of a story of the markets getting somewhat of a reality check on sort of the correction type of conversation? And also, of course, as we continue to digest the Fed government shutdown and what that could mean for December.
Yeah, I think you're right, Sam. It's a culmination of a lot of things. First, if we just go back and look at, this bull market that has been so resilient, just powering forward, but moving up on the same good news, dovish Fed, strong economy, AI secular growth story, et cetera, et cetera. Sam, let me just, for the audience, so they know, I'm more of a near-term kind of technician. I write a weekly blog. I put out a daily options blog. So my lens is a lot more narrow. So let me just tell you what I see over the past week. If we go back to even Meta's earnings on Wednesday, they punished the stock really bad for raising CAPEX. That wasn't the case for mega cap tech in prior quarters. Just a small little signal. Then you get a hawkish Fed. The market sells off, but then the dip buyers step in. But last Friday, what I noticed, and I noted this in my blog as well, the VIX was up like 10% with the S&P higher, which tells you that institutions, which largely go out to the SPX put options, were getting some protection out there, pushing up implied volatility, pushing up the price for protection. Then you go and look over at the semiconductor Philly SOX index over there, and you'll notice that there is a negative divergence in the RSI. What that means is that you get a new price high in the SOX with a relatively lower reading in the RSI. That's the negative divergence. Near term, it could just be a bit of an orange flag. And then lastly, we've got Palantir here that reported stellar results. I mean, I couldn't find anywhere that they didn't beat a metric handily. And yet the stock was down 8%. I think it's down maybe 7% right now. So selling off on good news, what is the signal that sends out to the market? You're already priced in for all the good news, my friend, Mr. Palantir, at forward price to sales at 80. That's not price to earnings, price to sales. When you begin to see stocks that are really strong like this, fundamentally, these growth stocks selling off on good news, well, the Psyche, the investor's psyche, then picks up on that and says, well, okay, so if I go out here and I decide to go buy some growth stocks, and if they beat results, I lose, and if they miss results, then I'm definitely going to lose. That begins to shift some of the near-term sentiment. So I'm not calling an end to the bull market by any means. The technicals are still intact. The Russell looks a little bit, wobbly. I'd be careful with that 50-day simple moving average. But I think when you see this type of price action, if you're a trader, maybe now you've seen enough orange flags to become cautious. And then we've got the labor statistics. If ADP comes in with a big miss, or we begin to get some more signals that the labor market is weak, well, the Fed still has their eye on inflation as of last week. Is the market going to be able to handle that? Okay, that's something that I have my eye on here in the next couple of weeks after we hopefully get some of these economic data reports, Sam.
I like the way that you characterize that, certainly what has got us to this point, and, at least as to what is being priced in here. I'm just wondering, as we think about what comes next, what do you think is going to be the biggest story sort of moving forward, given what we've seen over the last couple of sessions, a sort of more hawkish Fed? Or do you think it's going to be the sort of CAPEX indigestion that we saw, particularly off the back of Meta? And I mean, what do you see as far as the technicals are concerned as to, how to insulate yourself from that?
Well, I think we see all the evidence that the AI secular growth story is intact. Mega cap tech earnings look incredible, but it's always at what price? So we've pulled forward investors, we, the investing community, by bidding up all of these AI stocks to record highs, have pulled forward a lot of returns. So you begin to pull forward 2026 returns, 2027 returns. What does that mean? Well, you look at the current valuation, and then you're beginning to go off of 2027, 2028 numbers, et cetera. And at some point, when the stocks are going up, it doesn't really matter because you're getting rewarded for buying the dip and for chasing. when they begin to correct like Palantir is doing, now valuation does matter. So on the AI secular growth story, I think we need some digestion. But then to your point about the Fed and inflation and the labor market, that is going to be something I believe comes into focus here as we get some more of these labor statistics. ADP was minus 32K last time. The estimate for tomorrow morning is, anywhere from 15,000 to 26,000. That's not great. And so you look at, these anecdotal reports like Amazon laying off 14,000 employees, over 100,000 tech employees have been laid off this year. So you have this AI secular growth story that people are saying, I think that's impacting these layoffs in the tech sector. But then they say, don't worry about it because there will be new jobs to replace that. Well, there's likely going to be a gap between the layoffs and when those new jobs are created. Is the market going to be okay with a Fed that's a little bit hesitant to be in this easing mode if the labor market gets weak because of inflation? So these are really the two pillars that are going to take the spotlight here. Other than that, bullish seasonality, everything else looks okay. But those are going to be the two stories, I think, here in the next month.
Absolutely. That's what we've certainly been hearing as far as this two-track economy is concerned. Nathan Peterson, thank you so much for summing that up for us, a Director of Derivatives Analysis, Schwab Center for Financial Research.